The IRS just received $80 billion in funding, and a massive portion of that money went straight into artificial intelligence, data analytics, and automated enforcement systems. And if you think that this only affects the ultra wealthy or people with massive businesses, then you're making a very expensive mistake. The truth is that everyday people like you and I are actually the easiest targets for the IRS's new AI system. So today, as a budget analyst and a tax professional that helps people navigate this every day at timelessfinancialsolutions.com, I'm going to walk you through the biggest red flags that can trigger an IRS audit and show you exactly how to protect yourself while still taking every deduction that you are legally entitled to. Okay, so here is what you need to understand. The old IRS audit system was slow, random, and relied on human auditors sitting on desk and reviewing your returns one by one. But the new system is completely different. It uses artificial intelligence that looks for patterns and statistical anomalies across millions of tax returns. The AI doesn't ask, did this person break the law? Instead, it asks, did this person's return look statistically different from everyone else in your income bracket and industry? And if the answer is yes, then your return gets flagged for review. They call this the DF score or the discriminate function score. It's basically a math grade for your tax return. And if your grade is too far from the class average, you are getting audited. So let me walk you through the top red flags that trigger the system and how you can avoid them while still maximizing your legitimate deductions. Starting with red flag number 1 is the lifestyle versus income mix match. This is probably the most common trigger, and you don't need a Ferrari or a mansion to set it up. Here is how it works. Let's say you reported $70,000 in income last year. That sounds reasonable, right? But here is what the IRS's AI is doing behind the scenes. It's looking at your mortgage or rent payments, your car payments, your property tax records, and even your zip code's cost of living index. So if you're paying a $2,100 mortgage, a $700 car payment, and spending $1,700 a month on groceries and other expenses, that adds up to about $4,600 a month in fixed expenses alone. But $70,000 a year only gives you about $4,500 per month after taxes, which means you actually have nothing left for utilities, insurance, gas, entertainment, or anything else. The math doesn't work. And when the math doesn't work, the AI is going to flag your return. And here is something else that surprises most people. Yes, the IRS is also cross-referencing social media data. They're looking at your Instagram, your Facebook, and all your public posts. If your reported income says $70,000, but your social media shows you're taking luxury vacations, driving luxury cars, or living a lifestyle that doesn't match your reported income, that creates a discrepancy. And the AI is going to pick up on that. So the bottom line here is that your reported income needs to reasonably support the life that you're living. Otherwise, you're going to stand out in the system. Red flag number 2 is improper home office deductions. Now, the home office deduction is one of the best deductions available to business owners, and I absolutely recommend you take it if you qualify. But here is the problem. A lot of people get aggressive with this deduction without understanding that the IRS now has access to property tax records and even Zillow data. So let's say you own a 1,700 square foot home and you claim a 1,100 square foot home office deduction. That means you're telling the IRS that 66% of your entire home is used exclusively for business. Unless you're literally living in a closet and working in the rest of your house, that is not going to make sense to the IRS, and it's going to trigger a flag. And likewise, if you have multiple LLCs or multiple businesses and you're claiming a home office deduction for each one, you better have a distinct separate space for each each business. You cannot claim the same desk or the same room for 3 different businesses. That is double or triple dipping, and the IRS is specifically looking for this. So the key here is to be reasonable, okay? Measure your actual dedicated office space accurately and use it exclusively and regularly for business. And make sure the size you're claiming makes sense relative to your total square footage. Red flag number 3 is deductions that actually don't match your industry norms. Here is something that most people actually don't realize. The IRS doesn't just look at your tax return in isolation. They compare your deductions to a data set of millions of other people that do exactly what you do. They have standard profiles for every profession. So if you're a freelance graphic designer, the IRS expects to see deductions for things like software subscriptions, computer equipment, and creative assets. If you're a plumber, they want to see deductions for tools, vehicle deductions, and parts. But if you're a graphic designer and you're writing off heavy machinery, or if you're a plumber writing off luxury meals and traveling to exotic locations, those deductions fall outside of your industry's normal range. Now, does that mean you can't take deductions that are unique to your specific business? No. Absolutely not, okay? But it does mean you need to have exceptional documentation for anything that falls outside of the norm. You need receipts, you need business purpose documentation, and you need a clear explanation for why that expense was ordinary and necessary for your specific business. Red flag number 4 is the 100% business use vehicle trap. So this one is all over the internet. People saying just go buy a G-Wagon and write the whole thing off with Section 179 or bonus depreciation. And look, those are legitimate tax strategies, but here's the problem. If you only have one vehicle registered in your name and you're claiming 100% business use for that vehicle, the IRS is going to have questions, big questions, because think about it. Do you never drive to the grocery store? Do you never drive your kids to school? Do you walk everywhere for personal errands? Unless you have a second vehicle for personal use, claiming 100% business use on your only car is a statistical anomaly, and statistical anomalies trigger audits. And here is what happens when the IRS questions your vehicle deductions. They're going to ask for your mileage log, and that log needs to be contemporaneous, meaning you tracked it as it happens throughout the year, not 6 months later when you're scrambling to prepare your tax return. If you don't have a detailed contemporaneous mileage log showing the date, destination, business purpose, and miles driven for each business trip, they can disqualify your entire vehicle deduction. You're going to owe back taxes on the depreciation you claimed, plus interest and penalties. So instead of being aggressive here, be realistic. Track your actual business mileage throughout the year using a mileage tracking app and claim a percentage that actually reflects your business use. Red flag number 5 is running a business that never makes any profit. Now listen, losing money in your first or 2 years of business is normal. We've all been there. Building a business takes time and investment. But here was the thing. If you're losing money year after year after year, 3, 4, 5 years in a row, the IRS starts questioning whether you're running a legitimate business or just operating a hobby that you're using to generate tax deductions. This is called the hobby loss rule under Section 183 of the tax code. And if the IRS determines that your business is actually a hobby, they don't just say stop. They go back and reverse all the deductions that you took for the last 3 years. They add penalties, they add interest, and it could be financially devastating. So how do you protect yourself here? You need to show intent to make a profit. That means having a separate business bank account, creating a business plan, and actively marketing your services or products, keeping professional books and records, and demonstrating that you're operating like a real business and not just writing off personal expenses through a side hustle. hustle. Now, this doesn't mean you have to be profitable every single year, but it does mean you need to show a path to profitability and operate in a business-like manner. So if you have a side business that has been losing money for multiple years, you might want to reevaluate your strategy, or at least make sure you have all the documentations to make sure you're running it like a legit business. Red flag number 6 is excessive meal deductions. Now, business meals are 50% deductible if they meet IRS criteria, and we talked about this earlier in the video. There needs to be a business purpose for the meal and a business contact present. But here's where people get into trouble. If you're a sole proprietor making $60,000 per year and you're claiming $12,000 in meal deductions, that is 20% of your entire gross income spent on meals. The IRS is going to flag that because statistically, it doesn't make sense. And when they start looking closer, if they see charges at Starbucks, Chick-fil-A, and the local pizza place every Friday night, those don't look like business meetings. They look like personal meals that you're trying to write off. So here is what you need to do. First, only deduct actual business meals that meet the criteria. Secondly, keep detailed records. That means saving the receipt and noting on the receipt who you met with and what business was discussed. Make sure they are legitimate business meals and document everything. The documentation is what protects you. Red flag number 7 is abusing the short-term rental loophole. Now, the short-term rental loophole is a legitimate tax strategy that has been getting a lot of attention lately. Here's how it works. Normally, rental real estate is considered a passive activity, which means you can only use losses from rental property to offset other passive income. But there's an exception. If you rent a property for an average of 7 days or less per stay, it is no longer treated as rental real estate. It is treated as a business, which means if you materially participate in that business, you can use the losses to offset your W-2 income. And those losses often come from depreciation, which can be substantial. But here's a catch. You have to materially participate in the short-term rental business, and material participation requires spending significant time on the activity, typically at least 500 hours per year. And here's where people get caught. If you work 60 hours per week as an engineer or a therapist, and you claim you spent 500 hours managing one Airbnb on the side, the math doesn't work. There aren't enough hours in the day. So the IRS is now specifically looking for this. They'll check your messages with your cleaning crew, your maintenance contractors, your property managers, and everyone. And if you can't prove the 500 hours of material participation, they'll classify the losses as passive. So if you're using the short-term rental strategy, make sure you're actually materially participating. Keep a log of your hours, document your time, and make sure the time commitment actually makes sense given your other work obligations. Otherwise, you're setting yourself up for an audit and a potential reclassification that is going to cost you. And finally, red flag number 8 is writing off personal vacations as business trips. Listen, this happens all the time. Someone goes to Central Florida where Disney World is located for a week, attends a conference, or has one business meeting and tries to write off the entire 7-day trip as a business expense. Stop doing this. The IRS knows this trick and they're actually looking specifically for it. The rule here is simple. If the primary purpose for the trip is business, you can deduct your travel expenses. But if the trip is primarily personal with a little business mixed in, the travel expenses are not deductible. And the IRS looks at several factors here. They look at the ratio of business days to personal days. They look at whether the destination is a resort location. They look at international travel even more closely. And if you can't document that the majority of your trip was spent on legitimate business activity, they're going to disqualify the deduction. So how do you protect yourself? Document everything. Keep your itinerary showing your business meetings and activities. Save emails proving the business meetings happened. And make sure the business purpose is clear and substantial. And if you're taking a trip that is primarily personal, don't try to write it off just because you had one business meeting. Only deduct trips where the primary purpose is genuinely business related. The IRS isn't just randomly selecting returns for audits anymore. They are using artificial intelligence to identify patterns and anomalies. And if your tax returns look statistically different from others in your income bracket and industry, you're going to get flagged. But here is the good news. You can still take every deduction you are legally entitled to. You just need to make sure your deductions are reasonable, well documented, and aligned with your actual business activities. Keep clean records. Maintain separate business accounts. Track everything contemporaneously and make sure your lifestyle, your deductions, and your reported incomes all tell a consistent story. If you haven't already, subscribe to the channel because in upcoming videos, I'll be walking through exactly how to document these deductions properly so you can maximize your tax savings while staying completely compliant. And if your tax preparer isn't helping you take every legitimate deduction available to you while also protecting you from audit risk, just apply to work with my team today at timelessfinancialsolutions.com. Link is in the description. You got this.